So the second case study that I want to discuss are closely held business interest contributions. The most charitably inclined people in this entire country, without exception, if I'm in Salina, Kansas, or Philadelphia, Pennsylvania, or Miami, Florida, does not matter. It is always the same two groups: real estate wealth, closely held business wealth. There is never an exception. The most charitably inclined people are the same people who are likely the Rotary chairs 5 years in a row, and then Kiwanis and Chamber of Commerce. They are integrally involved with what's happening in their communities. Their success is directly tied to the success of their communities. They've grown their businesses there, they've developed land there, they've raised their families there, and they also want to be able to give back and make sure that the community that's helped them be successful in the first place stays vibrant forever. That is such a key point, because what do you think real estate investors own? Real estate. What do you think closely held business owners own? Closely held business interests. So when we're going into these case studies, and now we're talking about closely held business interest, keep in mind for your donors and your clients, the people that are the most charitably inclined are the ones that actually own the most illiquid assets. And they're also the ones, unfortunately, that make most of their charitable gifts with cash. That makes no sense. So hopefully after this case study, you'll be able to recognize some more opportunities, in particular with closely held C corporation assets. So very simply, in any individual that owns a closely held C corporation, my joke is about 92 to 95% of their wealth is tied up in that business, because their spouse is saying, don't put everything into the business, would like to be able to take a vacation once every 10 years. So most everything is in that business. Also, what is the adjusted tax basis for every single C corporation share in this country? I'm generalizing, but it's about 52 cents. It's always 52 cents. They set up their successful business in their garage. They have no paid-in capital or very little, and they have a very low cost basis. So I want to paint the picture. You've got a person who is usually very charitably inclined, who has a business asset with an incredibly low cost basis, that if it were to be sold, it's going to be a long-term capital gain. This should be setting up all kinds of bells and whistles in a good way for you from a planning perspective. This idea has been around since 1969, and you are not doing enough of it. So here's how it works. Very simply, let's assume that you have a matriarch of the family, and she has 70% of the business. She owns 70% of the outstanding shares. Then she has a daughter, a son, and a key employee, and they own 10% of the shares each. 10%, 10%, 10%. She owns 70, they own 10 each. That's 100% of the business. Now let's say that historically she has seen charitable need, she's been active in the community, and she's giving out of, I wince, cash out of her right pocket. And as a planning idea or suggestion, you come to her and say, perhaps you might want to consider, rather than giving cash, how about giving some of your closely held C shares? And she might say, I didn't even know that was possible. And you can say, since 1969, this has been possible. It's called a charitable stock bailout. And here's how that works. So let's say that she has her shares, and she turns around and she says, I love Salvation Army, and I'm going to make a gift of shares of $100,000 worth of my C corporation over to Salvation Army. When I give them those shares, they simply receive that in certificate form. And then my business can call and say, Salvation Army, I hear you own some of our shares. We would like to redeem those shares back, buy them back, for the company. And the Salvation Army says, that sounds great, because we don't want to be your partner in your business anyway. We'd like to get the cash. So you would actually have a qualified appraiser completing a qualified appraisal on those shares, and let's assume that comes back at $100,000. Then the company can buy those shares back using retained earnings, other cash, a loan, maybe even a note, buy those shares back for $100,000 and retire those shares into Treasury. What just happened? What just happened? The matriarch has been able to take $100,000 out of her estate and make that as a contribution of those shares over to Salvation Army. Then, if the company had a retained earnings problem, they were able to use that cash to buy those shares back and retire those shares into Treasury. She gets a full fair market value deduction for those contributions. And when the stock is purchased back, there's no capital gains tax at all. So she just used her lowest cost basis, highest appreciated stock holding, I would suggest, to be able to use that for charitable giving purposes rather than cash. And most importantly, what just happened to the daughter's 10% share, the son's 10% share, and the key employee's 10% share? All of those shares just went up, because when they buy the shares back and retire those into Treasury, they're no longer outstanding. So the daughter, the son, and the key employee now have more shares, the same number of shares, but they own a larger proportion of the business itself. No transfer tax at all. So she's able to use the lowest cost basis, highest appreciation property, using that for her charitable giving. When else can this come up? Perhaps prior to a merger or acquisition of her business. Perhaps if another shareholder wanted to buy in, or if an existing shareholder wanted to increase the number of shares in that business. We've done a number of cases actually with investment advisors where there's a founder of the business and they had a minority interest holder that wanted to buy in as an equity holder in that business. And very simply, the founder just said, here's the charity that I wish to make a gift to anyway. We will have the new equity partner buy in by simply paying the exact number of appraised value, the same share value, to the charity, and now I can use those charitable funds to pre-fund all of my future giving or to make all my gifts to that specific organization. So that's how this case works. Incredibly simple to do under a multitude of scenarios where you have a founder or a key shareholder in a C corporation who's charitably inclined to be able to use those shares rather than cash to make the charitable contributions.